Now, the last 6 months has been a war ride to say the least, with the start of the Russian-Ukraine conflict and China's unwavering stance towards their COVID-0 policies. As a result of these events, the global economy and inflation turned for the worse, mainly due to the worsening supply chain as well as a spike in commodity prices. In this semi-portfolio update, I would like to go into a few key points, mainly number 1, how had the portfolio performed based on our expectations and what had actually materialized. Number 2, what were the actions taken in the past and what are the potential actions to be made in the future? Number 3, what are my expectations and my analysis for the second half of the year? And number 4, closing messages for the investors. Now, I'll timestamp all the different sections, so feel free to jump around if necessary. Without further ado, let's get started. Expectations versus reality. Now, in the beginning of the year, I've mentioned that 2022 will be a rough year for the markets and that we'll likely see a correction in the market as number 1, the valuation in the US markets are unlikely to be sustained. Number 2, the Asian market will be brought down with the US market due to its correlation. Well, the outcome played up to my expectations. The trigger of the correction was something that nobody could have foreseen, and that is a Russia-Ukraine war. As a result, year to date, the performance of our funds is mostly negative, which, once again, is to be expected. Now, looking at these figures, some of you might be wondering if I did anything to protect you guys, and that brings me to my next point. Actions taken and potential moves in the future. For clients who has been with me for a few years and have accumulated a sizable amount of assets, I've taken the necessary actions to reduce our risk in a time when the market is showing signs of overvaluations. An example of that is the sidelining of our assets back in July 2021, where I've sold off a bulk of our portfolio to take profit while parking the funds in a money market fund which is less sensitive to the volatility. I've also presented to you guys on my implementation plan to reinvest the funds that were sidelined and the expectations and price levels that is to be expected given the coming correction during our third quarter 2021 portfolio update, of which what was being discussed was triggered in 2022. Now, while the forecasted market timing wasn't perfect, the outcome of the analysis still played out in 2022, of which we started to buy back into the market at way lower prices, using the funds that we had previously sidelined and also adding in additional funds to lower the average cost price of our investments. As the bear market continues, I will be redeploying the remaining balance that we have left into the markets, and should the global markets reach the fair or undervaluations, a portfolio rebalancing will be conducted to rebalance our regional allocation, given that the bulk of our current portfolio is concentrated in Asia due to its attractive valuations and higher future growth potential. Now, for clients who are not involved in the portfolio rebalancing because of the impracticalities of doing so, I've made a video on this, so if you want to take a look at it, if you're curious as to why you're not involved, please go and check the video out. Expectations for the second half of 2022. Now, once again, I have to reiterate that I am not God, right? While the outcome of the analysis may be accurate, it is impossible to time when the outcome will materialize, as we've clearly seen from my past records. Now, moving into the second half of 2022, here's what I believe is going to happen based on what is currently going on in the world right now, and as well as the fundamental and technical analysis. Now, the second half of 2022 will be crucial, as depending on how the inflation situation pans out to be, it will dictate whether or not a recession in 2023 and 2024 is avoidable. Now, should the global inflation situation persist, the second half of this year to 2024 is going to be a very depressive period for the economy as well as the markets in general, as central bankers will continue to hike their interest rates, resulting in way lower economic activity as well as profitability. In fact, looking at how things are going, this appears to be the most likely scenario, given the impact that the Russia-Ukraine war has on commodity prices, as well as China's COVID-0 policies, which is a major contributing factor to global inflation that is beyond the control of central bankers. A quick glance at the fundamental and technical analysis will show us that the global equities, as represented by the S&P 500, has just corrected back to its normal levels. And at current price levels, fundamentally, the global equities are neutral, and technically there is more room for prices to correct moving forward. On the other hand, the fundamental and technical analysis will show us that the Asian equity, as represented by the MSCI Asia X Japan Index, is currently trading at an undervalued range. And at current price levels, fundamentally, the Asian equities are attractive. Though technically, there might be more room for prices to correct due to its correlation with the US equities. In the following weeks, I will be uploading the fundamental and technical analysis for both the Asian and global equity. So do subscribe to this channel to stay notified when the videos are up if you haven't already. Closing messages. Here at Consulting Daniel, I invest based on a regionally diversified, growth-focused approach, and to eliminate the factor of emotion, all decisions will be made based on the financial modeling which is built using historical data and reasonable assumption on future growth projections. Finally, those numbers will be stress tested based on the different plausible scenarios. In times like this where the market is driven by pessimism, there will come a point in time where the market becomes so severely undervalued as no investors have the courage to invest in it. Ironically, that is also the best time to invest as it is where market bottoms are formed. That said, remember that we are not here to play the role of God. The crux of our investment operations should not be based on perfect market timing, and it should instead be built upon identifying the right investments with reasonable future growth potential and investing it and holding it for the long run. That is also why we are investing using a hybrid approach where we dollar cost average on a monthly basis, and I will personally rebalance and position the portfolio on a lump sum basis when the situation calls for it, be it to be more defensive as we've seen from last July or more aggressive as we've seen from the first half of this year. Long story short, it's going to suck for a while, but eventually the market is going to recover and we will be fine. If you have any questions or concerns with regards to your investments, please PM me on WhatsApp or Telegram and we can schedule a Zoom meeting. Stay safe and I hope to hear from you soon.